So we'll start the topic called ratios or ratio analysis, whatever you want, you can say. Okay. Now, what is this all about? You have to understand. So see, we will start the topic with a small scenario or with a small hypothetical example. Let's say this is Mr. X. Mr. X is earning 50,000 rupees per month. Okay. Mr. X has certain committed expenses, like Mr. X has to pay a rent of 10,000. 10,000 goes for rent. Then Mr. X has to pay 5,000 for provisions. That is all the groceries they have to bring every month. That is committed expense. Committed expense is nothing but these three are the basic needs of a human being. Okay. So these rent, that is for housing, provisions, that is for fetching your hunger. Okay. And then clothing. Okay. Clothing is like once you spend, that's okay. So I'm not bringing that into this because every month you will not be buying clothes. So 5,000 is a committed expense for provisions. Let's say Mr. X is a married man, so he has children and he has to pay 5,000 for their education expenses. This is also a need. Then Mr. X has a vehicle. For that he is paying 5,000 as easy monthly installment EMI. So we can take as car EMI. Okay. So 10 and then 20 and then 25,000 he is already spending, and then 5,000 he has certain miscellaneous expenses. In weekends he goes for some for recreation, for like they visit some hotels, etc. So all in all 30,000 is like their committed expense, and he is left over with 20,000 rupees every month. Now, how come Mr. X can grow this money? Mr. X can grow this money in the sense this 20,000 can become some good amount in the future, not only through accumulation, but putting it into investments. It can grow many folds. That means it can grow like it can grow, and Mr. X can definitely get some very can become richer in the future. That's what I can say, because if the money grows, it makes you richer, right? Now see, Mr. X has 20,000. Every month he will be saving around 20,000. Okay. So at the end of the year, he may have 2,40,000 rupees in his account. Okay, this is not called growth. This is called accumulation of money. Now don't tell, sir, on January 1st he had 20,000 and at the end of the year he is having 2,40,000. So his money has grown. No, this is not growth. This is accumulation. What is growth? I'll tell you. If 20,000 today, whatever Mr. X is having, Mr. X would have invested this in any of the investment option, giving him 10% returns. Okay. So at the end of the year, Mr. X would have how much money with him? Come on, tell me. What, like, are your mics muted? Are you people active? Are you people hearing? Yeah. So how much Mr. X would have at the end of the year? 22,000, right? Please tell me yes or no.
Yes, sir.
Yeah. So this is just to explain you. I'm not going into any further detail like simple interest, compound interest. I'm not using any complex terminologies here. Just I'm trying to keep things very simple and trying to make you understand that investments are very important for for your money to grow. Otherwise, you will just accumulate, but never you'll become richer. So what happens? See, if Mr. X invests 20,000 here, okay, Mr. X has 22,000 at the end of the year with him, right? Like say, if again Mr. X is investing second month's 20,000 and he like at the rate of 10%. See, he saves 20,000. So he puts this 20,000 in an account giving 10% returns. Mr. X again is investing some this 20,000 rupees in some account which is giving 10%. For 9 months he may get somewhere around some 1,900. Let's say, see, just small example. So it may make 21,000 900. Okay. So Mr. X has become richer by some around 1900 here. So in that way, if 2,40,000, let's say Mr. X has at the end of the year, let's say it is accumulated money, right? Mr. X has 2,40,000 at the end of this year. He puts this into investment option, okay, giving 10% returns. He may have how much at the end of next year? Let's forget this monthly payments is putting into investments. We understood monthly payments put into investment is giving some returns at the end of the year. But let's say he has accumulated some money of 2,40,000 and he is putting into investment. So how much he may have? Tell me.
2,64,000.
Yeah. So how you got this 2,64,000? He may get 24,000 like returns, and that added to 2,40,000 will become 2,64,000, right? So this is what the answer is. So we understood that money, if money is put into investment, definitely it will grow. If money is just accumulated, it will never grow. And what will make us richer is the growth of money, right? So now let we have understood this importance. So Mr. X now is in dilemma. Mr. X says I am saving 20,000 every month and I will have 2,40,000 at the end of the year. What can be done with this money? So there are range of options available for Mr. X to invest his money into, and Mr. X being a employee in a company, he is an employee. So he has certain limitations. He doesn't have business acumen, and see he has 2,40,000 at the end of the year, right? So Mr. X is thinking many options, or considering many options. Lot of things are coming into his mind, like what to do with this money. Okay, so Mr. X first thinks that I am an employee of a company. I have certain limitations. I don't have business acumen. If I start a business with this investment, whether it will work out for me or not, whether I'll be a profitable businessman or not, or in the sense whether I may make profits from this investment or not, he's having a dilemma. Point number one. Point number two is that means he's considering own business. Give me a second, please. Yeah, so he like to some extent he considered to start his own business, but again he thinks that if he starts his own business, what kind of business he may start? He is considering lot of options. A eatery. See, what I am trying to explain you is through a very good live example. This is called financial modeling. Let me be very clear. Many people can make financial models based upon their thought process for any businesses. So I know this is not there in your curriculum, but thought process is very important. You should think in such a way. The subjects, the studies are not very tough, but the thought process should be developed in such a way that you consume it rather than you just studying. Okay, it should be there in your blood. I mean to say, you understand this kind of sayings. Things you should be creative. Things should be such like it shouldn't seem to you like you're learning something. No, this is what I already know, just adding up something, that's it. So own business, he can start a eatery, he can start a coffee shop, but again he thinks that he is a employee of a company. Where will he find time to run his own business full time? It's a tough task. He can't devote his full time. If he has to devote full time, he has to resign the job. Okay, that is not easy for Mr. X, because Mr. X like doesn't have business acumen, and he is not that risk taking person. So to do a business, you should have risk taking abilities. You should take risks, high risks. A person who can take high risks can only do a business. That means if 1 or 2 months your business is not running, or any COVID kind of pandemic hits your business, you should not be crumbling. You shouldn't be panicking. Okay, that means coming home and then just creating all the fuss, chaos, and like going in stress. No, 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 no. That is not the cup of tea for a businessman. A businessman is one who is risk taker. An entrepreneur is one who knows how to take high risks. So if someone cannot take risks, it is better to do jobs. But since Mr. X is saving lot amount of or good amount of money, he's considering lot of options. Second, so he considers this, but it is not going well for Mr. X. So I will cancel out this option, because he cannot give his full time. Part time business is not going to work for him. He is not trusting any XYZ friends or partners with whom he can collaborate and do this business, because he doesn't want to take that risk. Okay, he is not a risk taker. Point number two, he is considering real estate. See what a person thinks. You put on the paper real estate 2,40,000, not a very big sum to buy a plot of or piece of land in Hyderabad or around the city, because city, it's like city has whatever the lands are available in the nearby proximity are very costly. This is not going well with him. Gold. Real estate is a very good investment, but again he has to wait for very long term to get some good returns, and he doesn't have that funds as well to buy a piece of land. Okay, now I'm not going into other aspects, real estate funds, real estate mutual funds, or kind of other things. I'm not explaining you, not there in your syllabus. Gold in 2020, in the year of pandemic, gold was available for 30,000 rupees per what, 10 grams. In India, we say 1 tola, right? In 2022, what I saw is this has gone to 60,000 plus. That means if someone has invested 10 lakhs in 2020, would get how much in 2022? 20 lakhs. Almost double. And gold is still growing. But again, that much money Mr. X did not have. He considered, but he did not have that money. And he was not that keen as well to buy gold. Okay, so he has cancelled this option as well, because gold is giving 200% returns here. Not the case always. If someone buys gold today of 10 lakhs, there is no guarantee that gold will give 100% returns in 1 or 2 years. That during the pandemic it happened. It was a very, very miraculous thing, but usually that is not the case with the gold. If you see the charts, or if you see the trend, okay, in the gold prices. Then fourth option, what Mr. X is thinking, why not give this money to someone else as a finance, okay, by taking collateral or something from others. But again, legal issues are involved in that. Without license and all, you can't do a finance business. If at all you are doing it like not by following all the norms or giving to some relative, there's a lot of chance that they may default. He's considering another some option, he's considering bonds. Yes, bonds are good investment. I will recommend that because Mr. X is an employee, and Mr. X can put his money into bonds. Bonds are somewhat secure and safe investment, because they have the backup of company's assets. You know what is bond, right? Now unmute your mic and tell me the difference between bond and a stock. I'm asking something. Please unmute your mic and tell me what is the difference between bond and a stock.
Sir, bond is something that a company. Hello.
Yeah. Yeah. I'm hearing.
Sir, bond is something through which a company raises money. It is a form of debt, and regular interval of payment is made to the investor in the form of interest or coupon. And the stock is a part. And a stock is a part of the ownership given to the investor.
Very good. See, let's say there is a company, there is a ABC company. It requires 100,000, it requires 1 lakh rupees as capital. Okay. It can opt for two options. Either it can raise the fund, raise this capital in form of bonds or debt. Bond is nothing but debt. Or it can raise the money in form of equity. Stock is nothing but equity. Equity is nothing but giving ownership to people in the ABC company, and debt is nothing but ABC company is borrowing from people. Okay, ABC company can borrow from bank. Okay, either they can borrow from bank or they can borrow from people. So if they have to borrow from bank, they have to put their assets, whatever the assets they have to mortgage with the bank as a collateral. Okay, same case goes with the bond as well. But the only difference between this is maybe bank is offering the giving the loan for 10%. In case of bonds, company can get it for 8% maybe. So what company does? Company has assets of 1 lakh. Let's say company has assets of 1 lakh. Okay, what company will do is company will make some so let's say they want to issue bond of 1,000 rupees each. So they'll make how many promissory notes in this case? 100, because 100 into 1,000 is what? Hello? 1 lakh, right? So they will make some 100 promissory notes. On that they will the denomination, that means each and every promissory note will be of 1,000 rupees, and it will have the backup of company's assets. That means tomorrow if company is defaulting, the investors or the bondholders can approach court, and court can order the company to sell their assets and give money to each and every bondholder to the tune of 1,000 rupees. That means one promissory note is nothing but like a bond in which company has clearly mentioned that they are liable to pay 1,000 rupees to the holder of the bond, and the guarantee that they will pay, that means there's no guarantee of someone paying, but if they don't pay and they default, the assets are pledged in that promissory note. Okay, that means this 1 lakh has been divided into small fragments. Instead of just putting that entire money with the mortgaging that entire asset with the bank, they have mortgaged the assets in fragments. Okay, to 100 people. Did you understand? And then the condition is, till the time the company does not pay this money, they will pay interest to the bondholders, because it's kind of a borrowing or debt from the bondholders, isn't it so? And on maturity date, that means let's say it is they have borrowed the money for 5 years, they will repay the money, entire money to the bondholders. That is the maturity date. So bond is a very good investment for Mr. X, but Mr. X is not that like a person who just will take the bond and just keep quiet and just enjoy the interest. No, Mr. X wants some thrill and excitement. That means he also wants to enter into the world of stock market, whereby he wants to enjoy all those movements in the stock prices on daily basis and wants to gain out of it. So Mr. X is seriously considering stocks. This is what. So now we will not consider all those investments, we'll consider only stock. Okay, let's come forward. So Mr. X has now finalized that he is going to buy stock of some company, because some of his friends said that they have bought some good some stocks of some very good listed companies or blue chip companies. Listed companies are the ones which have registered themselves in the stock exchange. So there are two types of like stock market exchanges. One is Bombay Stock Exchange, one is Nifty. In Bombay Stock Exchange, there are 30 companies. In Nifty, there are 50 companies. Okay. So there are some topmost companies which you find in BSE and Nifty. So he is considering to put his money into, let's say, any company, let's say Reliance. Okay. So Reliance company stock he wants to pick and wants to put the money into Reliance stock. And what he is doing is some amount of research he has done. He has done some technical analysis. Now, what is technical analysis? He has taken the chart of Reliance company's stock prices, and he's seeing that there is a good trend, that is there is an increasing trend in the stock price of Reliance company stock. That means someone who has bought Reliance company stock 1 year back for 100 rupees is now is now at what position? Let's say 160 rupees. That means there is a jump of some 60 rupees above this 100 rupees. So Mr. X thinks, yeah, it is a very good thing, and Reliance company is also giving some dividend of 20 rupees. That means in a span of year, people have made good returns. So how can you calculate and tell me, Bhargav and Umayya, like how much returns people have made out of this stock purchase? Any clue?
60%, sir.
Sorry?
60%.
60%. No, 60% is only capital gain. So there are two things here. Dividend is also there. Dividend yield is also there. So total shareholder return. Formula, instead of, see, formula is like what it is, P1 minus P naught plus D by P naught. So instead of understanding the formula, you see the stock has gone to 160 from 100, right? So there is a 60% jump. That is nothing but P1 minus P naught, P1 minus P naught by P naught. That is 160 minus 100 by 100. So we can see 60% jump. That is called capital gain. But there is also dividend yield. That is this dividend by share price. So dividend is how much? 20. Share price is how much? 100. Okay. And this is 20%. So now if I put into the formula, 160 minus 100 plus 20 whole divided by 100. 160 minus 100 is 60. 60 plus 20 is 80. 80 by 100 is 80% returns. Okay. Did you understand this one? Hello. Yeah. All of you, did you understand? This is the total shareholder return for an investor. Okay. That is nothing but capital gain from the stock plus dividend yield is equal to total shareholder return. So now Mr. X is very much excited because Mr. X has seen the charts of Reliance company and he has seen that the company is giving 80% returns. He will never get this kind of returns if he buys a bond of any XYZ company anywhere in the world, and only stocks can give him this kind of returns, not any mutual fund, not any funds, any kind of SIP. No, only equity can give that kind of returns to him, because lot of factors are there to be like, because of which the stock prices go up. Okay. So Mr. X has made up his mind that now he is going to put his money into a particular stock, that is Reliance Jio. Fine. Reliance or Reliance Industries or Reliance Jio. But that was only technical analysis. Technical analysis is all about studying the charts of a company. That means seeing the trends of the stock prices, which is not a complete analysis or thorough analysis about a company's performance. What should now be done to completely analyze a company's performance or a thorough analysis is nothing but, along with technical analysis, Mr. X has to do fundamental analysis. What is that? So under fundamental analysis, Mr. X is going to study the financial statements. That means he's going to analyze the financial statements of the company. Okay. So we will not go into all this. Okay. We will just see financial statements have to be analyzed. What is the analysis of financial statements? Current year statements. Current year statements should be compared with previous year statements. If current year statements are compared with previous year statements, they come to know what is the position of the company in today, in today's like time period when compared to previous year. Let's say the company's previous year statements. This is the format: revenue. I'm just putting a small format: revenue, less COGS, that is cost of goods sold. You get gross profit, add all incomes, subtract all expenses, you get net profit. That's more than enough. So altogether, this net profit of the previous year was the current year profits are 16,000 rupees. Now tell me, come on, and the sales are like near about, let's say previous year also it was 1 lakh sales, and this year also it is 1 lakh rupees of sales they have done. But this year they have made a profit of this much, and previous year the profits were less. There can be n number of reasons for that. Maybe this year the cost has reduced, maybe they have increased the selling price. There can be n number of reasons and factors. I'm not going into it, just I'm trying to explain you. This year they have the performance is good, and that we can only do that we can only conclude after doing a financial statement analysis, and this is called comparative analysis. What is that? Comparative analysis. Okay, but this is one of the types of analysis which which an investor can do on his own, or some expert whose services an investor can take, and he can also do this. That means I am speaking about an analyst. Let's say Mr. X is a doctor and he doesn't have any knowledge of finance. He is new to the world of finance. Then what? He can take the services of an analyst, and the analyst would also do the same thing. He is going to do the technical analysis, fundamental analysis, going to study the financial statements thoroughly, compare the statements of current year with the previous year, and he can forecast the future of the company. In all this analysis, one we will add one more type of analysis to understand the performance of the company in various areas, and that is nothing but ratio analysis, which is our topic today. Okay, anyone, if you want to ask any questions, you are free to ask. Anyone wants to ask something, some doubts you have? Yeah. So now we have understood that there are various types of there are various methods through which a company's performance can be analyzed. Okay. One is the financial statement analysis. In that I've explained you comparative analysis. There is one more analysis called common size analysis, which I am not explaining, not there in your syllabus right now. And the third one is ratio analysis. Now this is my topic for today, for which I have given all this introduction to you. So ratio analysis is also one of the methods with the help of which a company's performance in various areas can be judged. In what areas? What are all those areas in which a company's performance should be assessed or judged before doing an investment? Is nothing but this is what is the list here. First, liquidity. So I'll put it as areas of performance measurement. So first is liquidity. So if you want to invest in a company, the first and foremost thing is you should check the liquidity position of that company. First and foremost thing. Second, we will come to this particular aspect or this particular area which we will discuss in details. Second is solvency or long-term liquidity. Third one is turnover. Fourth one is profitability. Fifth one is overall profitability. Okay, so these are the areas of performance measurement. That means if I want to consider my investment target as Reliance Industries, that means if I want to invest my money into Reliance company stock, then I will check the performance of Reliance Industries in all these mentioned areas. That is, I will check the liquidity position of Reliance company. I will check the solvency or long-term liquidity position of Reliance company. I'll check the turnover of what kind of turnover they generate, and how are they generating enough turnover, like so that money can be invested in their stock, or what is the profitability of Reliance company, and also about the overall profitability. This is related to more often related to investors. This I will also call as investor ratios. So I will explain you why I say this as investor ratios. I will explain you afterwards. Okay. So now, as we have understood that we are doing a due diligence. That means we are not blindly investing in a company stock. If someone is saying us, you just buy the stock of Reliance company and then see that you are going to get exceptional returns, exponential returns, XYZ terminology someone is using. We are not blindly following his words, his or her words. See, let's consider that Mr. X is not a doctor and okay, let's say Mr. X is in the world of Mr. X is a doctor, and Mr. X has got a lot of suggestions about various companies. Amongst them, Reliance is also one. But being a doctor, he may not have good idea about all this world of finance and all these areas of performance measurement. He may know very good about medicine, but not about this. Then he has to definitely approach an analyst or an expert to do that. And he approaches Mr. Y. Mr. Y is a consultant. He has a consulting firm. He prepares models for various businesses. He does analysis of various companies, companies. He studies all the companies' performance and prepares financial reports for some various listed companies. So he is a big shot, and he has a very good consult. He has a big consulting firm, and he also maintains certain. He also does some AMC, a new business he has started. As he also has an asset management company. That means he gives services of like asset management. Okay, and he also gives certain services to some various mutual fund companies related to portfolio management, how to make their portfolios, and what are the good portfolios of stock they can make and sell it to people as a fund stock. So all kind of services Mr. Y does, and a very trustworthy name in the market. Mr. X is a doctor. That means he is earning well and he wants to take services of Mr. Y. So then Mr. Y will study about Reliance company, or he will have a detailed report of Reliance company in all these areas which I have mentioned here. Okay. So now let's say I will consider the first option today, that is liquidity. In that area, what Mr. Y has analyzed, or how, or what is the suggestion of Mr. Y with respect to the liquidity position of Reliance company, and whether Mr. X should consider Reliance company as an investment target or not, based upon Mr. Y's suggestion. Okay, so Mr. Y starts the task, as he has been given the task to judge the Reliance company performance. So Mr. Y here, what Mr. Y does, he is checking the liquidity position of Reliance company. So what he does under that, he find there are three ratios what he will be using to judge the liquidity position of Reliance company. So the three ratios are mentioned here. One is current ratio. One is quick ratio. One is cash ratio. Okay. So these three ratios will be considered by Mr. Y to study about the liquidity position of Reliance company. So what is current ratio? Anyone knows the formula for current ratio? Any one of you who knows the formula of current ratio? Okay, I'll write it. So current ratio is nothing but the ratio of current assets upon current liabilities. Okay. Quick ratio is nothing but the ratio of quick assets upon current liabilities, and cash ratio is nothing but the ratio of cash and cash equivalents divided by current liabilities. Now you should tell me one thing. What are current assets and what are, like, what do you mean by current asset? What's the difference between current asset and non-current asset? Come on. Hello. I'm asking
Sir,
what's the difference. Yes, yes, yes,
the,
please.
the current assets are those assets which are exhaustible in 1 year or whose benefit can be derived within 12 months.
Yeah. So current assets are those assets which can give you economic benefits within 1 year span or 1 year. Okay. And non-current assets are such which will give you economic benefits that if you are like holding those assets for more than 1 year, or you continue to hold those assets for more than 1 year. That means if you have a investment you have done in land, so land will not give you immediate returns. You have to wait for 10 years almost to get some good returns from that particular purchase of land. Do you understand? So that's the reason why land is always a non-current asset, and some of the and current assets are something which can give you economic benefits within 1 year span of time. So can you give me some examples of current assets and what is a current liability? Umayya, what is a current liability?
The amount to be paid within 1 year.
Yeah, these are the obligations which have to be settled within 1 year span of time. Very good. So some examples of current assets and current liabilities, if you can tell me, I'll write it here.
Current asset gold.
No, no, like generally what you see in the balance sheets of the company. Hello. Okay, can you tell me, Bhargav, what are the examples of current assets and current liabilities?
So current assets will include cash, inventory, short-term
Okay,
advances.
cash in hand, cash at bank, inventory, short-term investments, outstanding income, prepaid expenses, okay, receivables, any kind of receivables will come under current assets. Okay, I think I've covered almost everything. Current liabilities, bank overdraft, short-term loans, outstanding expenses, income tax, what you'll pay in the current year to the government, and payables. Okay, if I've missed out anything, maybe the list can be very big, but almost everything I've covered. So this, what did we discuss about the current ratio? Is the ratio of current assets upon current liabilities. So what Mr. Y would do, he would take the balance sheet of Reliance company. He will add all this above mentioned current assets and he will add all this above mentioned current liabilities, and he will get the total of current assets and current liabilities, and he'll put that in this formula of ratio, current ratio. That is, let's say the total of current assets here, total of current assets happen to be 200,000 or 2 lakhs, and total of current liabilities happen to be 1 lakh. So what is the ratio here? 2 is to 1. Okay. Now, my question to you. If the ratio of Reliance company is 2 is to 1, shall Mr. X invest in Reliance company? Before Mr. Y answering, you should answer. Come on, tell me.
Yes, sir.
Sorry,
Yes, yes.
why?
So because on an average, the current assets should be greater than current liabilities, so that the liabilities are backed by them.
Very good. See, any day, if you want to check the liquidity position of a company, you can check the liquidity position of that company with the help of the current ratio. How? Here, the liability what Reliance company has is of 1 lakh rupees. Okay, or 1 rupee is the liability, and 2 rupees they have as resources. If they pay 1 rupee out of this 2 rupees, they still have how much rupees left over with them? 1 rupee. And this is very sufficient for them to run their daily routine activities very smoothly, or this can be taken as working capital for their business. Working capital is nothing but it is that fund which a business uses to run their operations very smoothly on daily basis. That means whatever the financial requirements or financial needs of daily basis are there, or routine basis financial needs are there, those can be fulfilled with the help of this working capital, this fund. So here, if Reliance company pays 1 rupee to their creditors or to their payables, they are still left over. So after paying 1 rupee, they are still left over with 1 rupee, and with that they can easily run their business affairs, right? So I feel here, or the standards say that 2:1 is always a very ideal current ratio for a company. So I'll write a note here. 2:1 is always a ideal current ratio for a company. Now, second point. Now, this is next question I'm asking. This is very important question. Try to answer this, both of you. 2:1 is ideal. I ask you one question that Reliance company is current ratio is 4:1. Is it good or bad? Good. Umaya says good. Bhargav, you tell me.
It is not every time good, sir. Like we cannot always say that a very high current ratio is also good
Why?
because
Why? That
so
because I
because
want.
current liabilities include factors items such as payables, and sometimes the profitability can be increased by having an optimum balance between the current assets and the liabilities so that the
No,
operations will be running smoothly.
I didn't get this. It's not up to the mark. See, if the current ratio is too high, it's not good. If it's low, then also it's not good. That's the reason why ideal is always good. If the current ratio is 1:1, don't invest in the company. Why? Because they will always struggle for funds. Why? If they use whatever they have, uh, let's say they have to pay 1 rupee to their to their lenders, and they have the resource also available of of the similar amount. Okay, that means if 1 rupee I have to pay and I have resource of 1 rupee, then if I pay off, what is left over with me? Nothing. So I am struggling here. Then how will I run my business smoothly? Then how will I fulfill all my daily financial needs? I have to borrow, I have to pay interest for that. That's going to decrease my profits, right? So not good. Then what about this case? The problem with this case is too much of current assets is also not good. Maybe lot of inventory and lot of receivables are there in this four, the number four. That means the reason for very high current ratio can be there are a lot of current assets what the company has. Now you will be asking a question, lot of current assets, how they are bad for a company? Oh, it is bad. Because if lot of amount is stuck in inventory, that means the inventory is not getting sold very easily, or it is not getting converted into cash very sooner. That means it's taking lot of time for them to get this inventory converted into cash or convert this into sales. That's the reason why lot of inventory, since lot of inventory is with them, and it's since long time it is with them, and it is not getting sold in the market, the inventory is still kept with them, and that becomes the part of this current ratio, the current assets of this current ratio, and it shows a very high amount in this current ratio. Point number one, this is not good with respect to inventory management, because in future if still the inventory is not getting sold, it may become obsolete, lot of loss to the company. There can be embezzlement of inventory, okay, theft from the employee side. So all these problems are there if it is always stuck with you. Point number two, lot of money is blocked in receivables as well. That means you have sold the goods on credit basis to many people and that is not getting converted into cash, which again is a big issue. Why? Because you are not able to, recover your debts very sooner or on time from your customers. That means lot of money is blocked in the market. And if you're not recovering that sooner, then there's a chance of bad debts, okay, uncollectible debts. And if you don't receive your money sooner, you lose the chance of reinvesting it again in the business or anywhere else and generating good returns. So again, this also being the part of current assets these two can definitely make the current assets value very much higher, and that shows serious mismanagement in case of inventory and also receivables management, which is not a good sign for the company. So they should try to convert the inventory into cash as soon as possible and try to recover their money from the customers as soon as possible and try to invest in the market. So they are losing all these opportunities, right? That's the reason why too much of current assets, higher value of current assets is also not good. As we say, if mother cooks the food at home and let's say there is a recipe here, she is cooking some oatmeal or some porridge, and like the instruction is 1 teaspoon of salt. Let's say, okay, this is good to be added to this porridge, whatever some quantity she's taking, and that can give good taste to this porridge, because without salt you cannot expect some taste, right? But so always imagine salt is to add taste to the food. So to add very much taste to the food, can I put some 3 teaspoons of salt? No, it will spoil my food. So over excess of anything is also not good. And also half teaspoon or pinch of salt is also not ideal. So the ideal is ideal always. That means 2:1. If it is very nearby 2:1, that's okay. Very higher than 2:1, matter of concern. That means they have some mismanagement. So you have to consider certain factors before investing in that company. Please tell me, did you understand this? Yes or no?
Yes, sir.
Yeah. So now what is the conclusion? The conclusion is based upon 2:1 ratio, we can definitely plan to invest in Reliance Jio or Reliance Industries stock. Okay. Then comes the second ratio, that is quick ratio. So I will explain these two ratios today, and because I have some shortage of time. Okay. Now, what are quick assets? Any clue? Quick assets are nothing but all the current assets except inventory. All current assets except inventory can be termed as quick assets. What I mean here with quick assets is I am only considering those current assets which are what? Less tangible in nature, less tangible or more liquid. That means my concern is I will only take those assets in calculation of quick assets which can get converted into cash in a span of 6 months. That is more sooner than the current assets. Are you understanding? If current assets can give me economic benefits within 1 year, the quick assets should give me economic benefits within 6 months. So I will eliminate all those current assets which can take a more duration of time to give me economic benefits, and inventory can be that particular kind of current asset which can take a longer period of time to give me economic benefits, probably more than 6 months, because we are taking more liquid assets and less tangible current assets. Did you understand what I'm saying? I want to take very less tangible nature current assets, and I want to exclude, or I want to skip very high tangible nature current assets. What do you mean by this tangibility? Tangibility means physical substance. See why land is considered illiquid. Why land is considered illiquid asset? Because it will take lot of time, a very long period of time to get you economic benefits, probably more than 10 years as well. It will give you, but very long time it will take. In the same way, all the current assets like this can give me immediate economic benefits, immediate, but this I don't have a status of this, because this is in all these current assets, this is the most tangible nature, having the physical substance and giving the economic benefits, even more, taking more time to give me economic benefits. So I'll exclude that. And then after excluding that, all the current assets what I've considered is nothing but quick assets, and I'll try to get my economic benefits even more short, in more shorter duration than the current ratio. Okay. So quick ratio is nothing but like quick assets upon current liabilities, and 1:1 is the ideal quick ratio. As we have removed inventory from the category of quick assets, definitely major chunk of current asset is not available here. So the ratios demand would also be less. That means here we don't want the ideal quick ratio to be 2:1. We want it to be 1:1. That's it. Okay. Now, if it is more than 1:1, somewhere nearby it, okay. If it is less than 1:1, you should not invest in Reliance company. Fine. And the last ratio, what we are considering is nothing but cash ratio. I will explain this here with the help of some example. Cash in hand, cash at bank, cash. I can take short term investments. That can also be termed as cash and cash equivalents. That means something which is not exactly cash, but it is equivalent to cash. That means immediately can be converted into cash. If you sell that in the market tomorrow, people are ready to buy it, like gold. Gold is also a cash equivalent. It may be some metal, but that metal is immediately saleable in the market. Gold divided by current liabilities. I would say 0.50:1 is the ideal cash ratio. Is the ideal cash ratio. Okay. So you have seen all the refinements, right? The refinement is nothing but in case of current ratio, you took all the current assets. In case of quick ratio, you removed inventory and you took all the current assets. Okay. And in case of cash and in case of cash ratio, you are excluding all the current assets along with inventory. That is, you're not taking outstanding incomes, you're not taking prepaid, you're not taking receivables, you're not taking inventory, you're taking only cash in hand, cash at bank, and short-term investments, right? That is what. So we are filtering every time we are going ahead. We are filtering. We are like, refining this. Now, as you have seen, 0.50:1 is the ideal cash ratio. I'll take an example here of apartment buy purchase. This is X. This is like P, and this is Q. Okay. So P and Q are two people who wants to buy an apartment. P has 20 lakhs of P has a resource of 20 lakhs. Okay. Q has a resource of 2 lakhs. That means let's say let's frame this example. 50 lakhs is the value of an apartment. 10 lakhs is the down payment. I will tell that 10 lakhs as equity because that is your contribution to that purchase of that property. And 40 lakhs is the debt. Okay. This debt will be taken from the bank. This will be borrowed. Okay. And 40 lakhs is the loan amount. 40 lakhs is the loan amount of which just a second. Yeah. So this is the equity. That means your down payment. This is the debt that is you are going to borrow. 40 lakhs is the loan amount. 30 years is what P and Q are given the time period to make the loan payment. Okay. And 30,000 per month is their EMI. Leave it. Now, what the case here is, you tell me who is stronger. 40 lakhs is the loan and 20 lakhs Mr. 20 lakhs P has with him today itself. 40 lakhs is the loan and 2 lakhs Q has with him today itself. Who is more stronger?
So the person with 20 lakhs.
Yeah, of course, common sense is that he is more stronger. Okay, always there is no like you know what we say, last moment surprises. Very clearly, the one who has 20 lakhs is always very much stronger when compared to the one who has 2 lakhs. But why? Because whatever the loan is here, of that 50% P has today itself, and whatever the loan is here, of that only some fraction amount. How much is 2% of 40? Yes, nearly 5%. So Q has just 5% of the funds available with him for the entire loan what he has to pay. But you will be having some questions, sir. What's the need here? They have 30 years to make the payments. They can every month make the payments comfortably till 30 years. That is 30,000. And how does it make sense that P is holding 20 lakh rupees of cash with him? So I will now do some kind of division here. P has 5 lakhs of cash and 15 lakhs of money he has put into SIPs, systematic investment plans and mutual funds. That makes sense now because he has put his good amount of money into investments and he can convert this money anytime into cash. That makes sense. Yes. So till here, now again you are not convinced. What, sir? He would have made the down payment, right? He would have made a bigger amount as down payment. Instead of making 10 lakh as down payment, he would have made 20 lakhs as down payment, and he would have been still with 10 lakhs. That was more than enough. Again, that doubt you have. See, it's upon P and upon Q how much down payment they make. We are not the ones who are going to guide them about down payments. But see, anytime you remember, housing loan is the cheapest loan what you can get, in the sense the rate of interest in housing loan is the least, and you also get deduction in case of the interest what you pay to the banks. That is bank, whatever the interest on home loan you are paying, you get deduction in your taxes as well. So you have very good benefit with that. Suppose let's say 10% is the interest, 10% is the interest rate charged by the bank, and 30% is the tax rate in the country. So 30%, your net cost will be 7% only. Why your net cost will be 7%? Because you can claim deduction of your interest expense whatever you are paying from the tax amount to the tune of 30%. See, these are all things which I have to explain you. But remember, it will take very long time to explain you about all these concepts because this is not your subject. But you remember, if home loan is of 10% and 30% is the tax rate, your net cost is just 7%. That means interest minus tax rate. That means, let's say your income tax what you are going to pay to government is 1 lakh, and your loan is of 10 lakhs, let's say, and of that 10%, not 10%. Okay, I'll just put it 5 lakhs. Your loan is 10 lakhs and your interest is 10%. So 1 lakh is your interest what you have to pay, and you can claim this 1 lakh rupees as deduction. Okay, how you can claim this as deduction? I will subtract this 1 lakh, and now 4 lakhs is my taxable income. I have to pay taxes on this 4 lakhs. So 4 lakhs ka 30% is how much? Yes, 1,20,000. Now, listen to my point. Previously, actually, if this interest wasn't there as deduction, I have to pay how much taxes? 5 lakhs into 30%. That is 1,50,000, right? So now, if interest expenditure was not taken as deduction, that means if the government of India did not allow you to claim this as deduction, now you will be asking a question, what is this deduction? Government of India is giving you an opportunity to reduce your taxable amount with this interest expenditure. So I have taken this interest expenditure, I am reducing my taxable amount, and my taxable amount is now 4 lakhs. And on 4 lakhs, if I am paying 30% taxes, it is 1,20,000. If this wouldn't have been there, my taxes would have been 1,50,000. I am saving how much? Net on net, 30,000. Correct? So if 1 lakh is my interest expense and 30 I am saving out of it, okay, this I am not paying as taxes. So net on net, how much is the expense I have? 70. That's what I said you. So if 10% is the home loan, 7% is only the cost to you. Okay, it's costing you only 7%. So very good benefits you have. So so P says, why shall I pay sooner? Okay, I have good amount of time and I have good amount of money. If I put this money into SIPs, I'm getting some 18% returns. How much returns? 18%. So my home loan interest expenses or cost is 7%. My returns are 18%. Always it is better, right? So 7% I can easily recover if I invest the equal amount. Equal amount is nothing but, let's say I have right now 20 lakhs. So let's say out of this home loan, 20 lakhs is the amount I already have. Okay. If I invest this 20 lakhs at the rate of 18%, I may get very good returns and I can recover my 7% cost also out of it. So net in net, I am getting 11% extra returns with my investment, right? I don't want to complicate that much this concept for you. So what I'm trying to explain you is this is a case whereby he is very much beneficial. And imagine there was an emergency and they required some funds of 7 lakh rupees. So who has that 7 lakh rupees fund here? P or Q?
E.
P. So any case, P has the emergency funds. Whenever there's an emergency, he can meet that emergency. He is having very good liquidity with him. Okay. And he has put his money into investment options and he is maintaining 50%. See, 40 lakhs is the loan, 20 lakhs he has with himself today itself. So he has 50% of whatever he has to pay today itself. So he's always in a very strong position, right? So for businesses, what we recommend is if they have 0.50:1 of cash ratio, they are always very stronger. So always whatever the liability you have of that 50% cash and cash equivalents you should have. I'm not saying that you should not have. I'm not saying that you don't have other assets with you. You may have land, you may have buildings, you may have any other kind of asset. But when it comes to immediate buying, or if you want to, exploit some chances in your lifetime, that means some opportunity has come to you, some offer has come to you. All this will take a lot of time to convert into cash. Only what will work out for you? The cash reserves what you have. That's it. Okay. So this is what is ideal for any company. If Reliance company has this ratio, Mr. X in our example whom we took in the beginning can immediately invest in the Reliance company. So okay, so what we have concluded today, we have seen the current ratio, we have seen the quick ratio, we have seen the cash ratio. All these ratios we have seen the condition or position of Reliance company. Okay, I know we did not have a original balance sheet of Reliance company. We took some imaginary figures and tried to figure out whether they have to invest in all this, whether Mr. X have to invest in Reliance company or not, by considering some imaginary figures and seeing what are the ideal ratios Reliance company should maintain. And if they are maintaining all those ideal ratios what we mentioned, that is 2:1, 1:1 and 0.50:1, immediately Mr. X can invest in Reliance company. And this was with the perspective of liquidity. Tomorrow's class will be covering the next other ratios. Okay, it will take 2 more classes to finish ratios, so you have to be very much focusing and very much concentrating on the subject, right? It was an introductory class, but next classes will be taking some original figures and trying to do some questions. Okay. Thank you.
Thank you, sir.
Thank you, dear. Thank you.